mid-cap shares are basically everything outside of the top 40 stocks. So you have around 166 shares in the all-share index, of which around 75% of the number of shares is made up of small and mid-cap shares. So it's a very broad universe. Typically, from a market cap perspective, you're looking at a 1 to 7 billion sized market cap for a small cap, and your examples of a small cap would be a Famous Brands or a City Lodge. On the mid-cap side, you have a 7 billion rand market cap to around a 40 billion rand market cap, and then obviously everything above that would be top 40. And in the mid-caps, you've got stocks like the retailers, Mr. Price, Freshini, or your food producers like AVI or Pioneer Food. Small cap shares have actually done really well so far year to date. If you look just for 2013, the small cap index is up around 10% for the year, whereas the mid cap index is up around 1% and the broader all shares up around 2%. But this is in contrast to what's happened historically, where the mid cap universe has been the star performing area of the market for the last 5 years. You've seen that because of the composition of that index, which comprises mostly of your very defensive industrial and financial stocks. On the industrial side, you've got your pharmaceutical companies, your food producers, your retailers, etc. And on the financial side, you've got your insurers, your short-term insurers, your life insurers, and some banks, etc. Those stocks have performed extremely well because they've had very predictable earning streams, great earnings growth coming out of them post the recession in 2009. And as a result, that area of the market is rated at a material premium to the rest of the broader market, where you've got a lot more risk, like in resource shares or construction shares or manufacturing shares. So as a result, if we look going forward, we don't think that, we can't predict what's going to happen with the index, but we look from a bottom-up perspective. And we think that the value is sitting more on the small cap side versus the mid cap shares, just given that premium rating that these very defensive industrials have attracted in the market. The smaller cap shares are perceived to be slightly more riskier. Some of them are a little bit delayed in terms of their earning cycles, and those recoveries haven't yet come through. So hence why we see more value in that space. Our portfolio is run strictly on a value-based investment philosophy, which we adhere to. And what we are trying to do is overlay a quality approach over that. So if you look in our top 10 shares, we're holding stocks like Spur, Advitech and Distel, which we believe have high quality business models with strong fundamentals. But these are small cap shares. And so we have more of a weighting to small cap shares because we see more value from a bottom-up perspective in that area versus the mid-cap shares. There is definitely a place for small cap investing. If you look over time, it's an area where you've got these smaller businesses that are levered to the general growth in the economy. And obviously, as their businesses grow, they can attract a lot better returns versus your mid and your large cap stocks that tend to be better covered in the market and better known by the investment community. So you often find a lot of mispriced opportunities in the small cap space, hence why it is a very powerful component of your portfolio potentially in the long run. Typically, small cap shares are mostly geared to stronger economic growth, a 3 to 6% kind of GDP growth range. That was, if you look in the last decade, that was when they performed the best at the later end of the cycle. But if we consistently grow at a 2 to 4% range, these stocks should be able to continue to tick along. From our fund's perspective, the sectors that we're interested in at the moment and what we believe are undervalued as well, so are congruent with our investment philosophy, would be the construction sector, where we see the GDFI cycle is at a very low point. And we expect a much better improvement there going forward. And most of the companies in that sector are at very low points in their earning cycles, and all the bad news is in their share prices. We also like the pharmaceutical space, but we're very wary of the consumer space. We think South African consumers are highly indebted. Consumption is under pressure in this market, and so we're very wary. We don't hold retail stocks in the portfolio at this point in time.